I know everyone wants to get out of here and go for lunch, but we have an amazing lineup of panelists here, so why don't we take half an hour to talk about the topic of HSC, which is institutional adoption. Today we're going to be discussing how traditional finance is entering the market through ETFs and real-world assets. Before we start, I'd love to give a quick introduction about myself. My name is Marina Barysheva. I'm the CEO of LKI Consulting. We're a growth firm that is focused on bringing TradFi institutions on-chain and helping retail DeFi protocols and L1s and L2s capture the institutional market. And now I'd love to turn to our exquisite panel and ask them to introduce themselves one by one. We'll kick it off with Ophelia.
Hi, I'm Ophelia Snyder. I co-founded 21 Shares, built it from 0 to 12 billion in assets under management, sold it to FalconX and exited last year.
Fantastic. I'm Paul Brody. I was recently deinstitutionalized from Ernst & Young, and I'm now the founder of a company called Nightfall Networks, which is a spin-out of the EY's blockchain privacy tech, and I wrote a book called Ethereum for Business.
Thanks, great panel. I'm Zach Pandl, head of research at Grayscale. Grayscale is the largest crypto fund management business in the world. We run a range of products from ETFs to private funds, covering everything from Bitcoin to BitTensor and many assets in between.
Hi everyone, my name is Marina and I'm leading the European Ethereum Institute. It's just a rebranding that happened 2 days ago from the European Crypto Initiative. We are an advocacy organization. We're based in Brussels and we worked for the last 7 years on different regulations, including the DLT pilot regime. I believe we were going to talk about it today, MiCA, etc. So I'm very excited for the panel. Thank you.
Awesome. So why don't we start by talking about the market? Bitcoin and altcoins have both seen better days, but if there is one thing that is thriving, is actually the scale of institutional adoption. Crypto ETFs have exceeded 150 billion. RWA volume is pretty high as well at 30 billion. What is the one interesting trend in the market that you see right now that you'd love to bring up today?
I think history is repeating itself, and let me talk about why. So I had the opportunity to sit down with a senior leader at one of the big exchange clearinghouses a couple weeks ago, and in preparation for that meeting, I took a look at where are all the asset exchanges, the stock exchanges, and all of these guys putting their assets, and the answer is they're all building on permissioned private blockchains. And I went back and I looked, and sure enough, if you go back 5 years, this was also true of all the major banks when it comes to stablecoins. They started on these permissioned systems, and then 2 or 3 years later, they're all on Ethereum, and some of them are also on a few other networks. And what really struck me is the degree to which the real-world asset industry, the institutional players, are repeating history and instead of learning from it. They're all building on permission systems, and I personally think 2 or 3 years from now, they're all going to be on Ethereum, just like their banking and financial services counterparts.
I would say another trend, more from my perspective, from regulatory perspective, at least in the EU and UK, I see that there's a lot of, I would say, support for tokenization when it comes to regulation of crypto assets. In general, crypto asset service providers, I think there was a lot of skepticism, there still is. When we're talking to supervisors specifically, like BaFin, Consob and others, not really the commission, they're still thinking about the risks around crypto assets. But when it comes to tokenization, they're really, really excited about it. When you're listening to the leadership of ESMA, the European SEC, you basically think that you're at the crypto conference of how excited and basically promoting they are on a tokenization side.
It's interesting. Over the last few months and years, what I'm seeing is actually kind of complementary. We're shifting from can crypto be an investable asset broadly to how can crypto rails be used to improve traditional financial operating process. I think as a trend, what we're going to see is an increasing push towards meeting what I would call financial market norms, not just in Europe, but also in the US and also globally, as we start to need to actually deliver this value that we've been promising. And I think right now there's still a gap in the market there, especially around like operations and how we integrate and how we foster backwards compatibility with traditional financial infrastructure. And we're at a really interesting turning point where you're seeing a lot of these POCs come out and you're seeing people actually start to ask questions around, well, okay, how is this really going to work at scale and how is it going to be operationalized across financial markets infrastructure? And we're seeing it at the regulatory level, we're seeing it at the firm level, and I think that's a really wonderful inflection point for the industry.
I love the comments. Agree with all that. Maybe just to offer something slightly different, I'll talk less about infrastructure and more about markets and prices and what's going on today. And maybe one thing I'd offer is that we interface, Grayscale interfaces with institutional investors of all types. And I think you may be surprised to learn that there's not that much difference between your retail degen and what some institutional investors, how they approach the market. They look at charts, they think about macro, they think about the Fed, just like everybody else. And so the message that we are giving to them at the moment, just in terms of the timeliest views, is that this is an extremely compelling entry point potentially for the crypto asset class. Over the last month, the S&P 500 is down 5%, bonds are down, precious metals are down, and crypto is up 4% on our index over the last month. It's pretty rare where there's a bid for crypto when other assets are so weak. That probably tells us the market is badly oversold. The paper hands, if you will, to use the degen terminology, have been washed out of the market. I see a lot of positive fundamentals, some of the things that the panel has talked about, tokenization, stablecoins, et cetera. So we are communicating to our investors that if you are under-allocated or not yet allocated to crypto, now is the time to start to be deploying. You can never pick the bottom exactly, but to me these are important signals from the market at the moment, and in my view, very compelling entry points for a lot of the assets in our space.
Thank you, everyone, to the insights. If one thing is clear, infrastructure is one of the major trends that is emerging right now. So with my question, I'm coming back to Paul. Paul, you mentioned that there are a lot of institutions who are showing interest in entering blockchain, but they're still playing in controlled environments. They're not building an open infrastructure. What are the top challenges, in your opinion, that are preventing institutions from bringing the TradFi financial primitives on-chain?
So a lot of institutions are definitely waiting for the Clarity Act. They want to have one of the things that we learned from the Genius Act that was really interesting is that large institutions don't just need to know that it's okay and they won't be prosecuted. They need a positive roadmap. Like if you go back to like the stablecoin era, and the analogies are so good, USDC, like Circle, the other providers of stablecoins, they weren't prosecuted. The SEC never went after them. Right? They generally were fine, and yet most banks waited until the Genius Act passed before they announced that they were going to get into the stablecoin business and something similar. We're going to see the same thing with the Clarity Act because financial institutions are so conservative. This is actually a very, very big risk for them. And the reason I say this is, at the end of the day, the Genius Act did speed up stablecoin adoption, but it hasn't changed the marketplace. If you were a leader in stablecoins before the Genius Act, you're still a leader today. And so if you are waiting for an engraved permission slip from the regulators to enter this market, you are missing your window to achieve a market-leading position because you are too careful and too conservative. And so my main observation is just fundamentally large institutions are much too risk-averse in an environment and with a regulatory leadership that is really working hard to be friendly to these institutions.
I mean, I think there's a secondary part here, which is that most of these solutions currently available that would allow you to integrate blockchain into your core architecture and actually put these rails in a critical path from an asset management perspective aren't fully mature yet. And there's also an element of that. Like when you think about financial firms, they're processing, I think what DTCC processes 4 quadrillion transactions a year, something like that. The scale of what we're talking about is enormous, and the tolerance for errors is functionally 0, but in practice, whatever, maybe 1% a year, and things that either don't settle or don't clear properly or have some sort of long-term impact. So there is an expectation of the type of infrastructure we are going to provide and the level of scrutiny that is going to be applied before you can think about saying, okay, you know what, actually, we're going to settle payments for all of our customers in stables, or we're going to do $1 trillion in stablecoin transactions. And I think there's just a size problem where sometimes, like as an industry, we don't realize quite how big TradFi actually is, because we don't realize how many components there are in the background and how many different layers and different steps would be required to actually do a major financial markets microstructure and infrastructure migration. And at least I think that is one of the things that I'm seeing as a major gating item as we go forward.
We'll just add one contribution to that. I think you're right. And I had a banker in Singapore tell me a really interesting and funny story. He said that migration into blockchain ecosystem crypto rails was triggering vicious internal political fights. Because in the past, if you were in stocks, you had the stock market. And if you were in bonds, you had the bond market. Now, everybody is on crypto. You need to share infrastructure, and that's triggering internal political turf wars in the IT departments inside of banks, which is something I had no appreciation for until he brought this up. I kind of knew that these things were separate, but it didn't occur to me that getting onto infrastructure, crypto infrastructure rails, was going to trigger this much disruption inside of the financial institutions.
I would maybe add the stablecoin you mentioned, like one of the first tokenization successful stories. In Europe, we have the problem with liquidity when it comes to also diversification with different types of maybe dollar-backed stablecoins, but even the liquidity when it comes to euro-backed stablecoins. So that might be another limitation.
Marina, I'll actually stay with you here because, Paul, you mentioned we're acting for the Clarity Act, but I doubt Clarity Act will actually bring us much clarity. In EU, we have MiCA that is supposed to fix the fragmented regulatory framework and help with the interagency coordination. But we're seeing much better adoption in areas like Hong Kong or Singapore with the sandbox environment, with the Projects Guardian. What needs to happen for Europe to finally get better adoption, apart from Token 2049 getting canceled, I think?
So that's a good question. As we know, MiCA is now applicable, I think, more than 2 years when it comes to stablecoin coins, and 1.5 years when it comes to crypto as a service providers. And I have just looked up the numbers, so maybe I can start with that. We do have 38 different registrations when it comes to e-money tokens, a specific type of stablecoins, 0 asset reference tokens. That's another story, why we regulated asset reference tokens as we have in MiCA. And we do have 174 different registrations for crypto as a service providers. I think this is pretty high as a number, but at least still, there's so many crypto as a service providers that have not gone through the registration process. There's a lot of them that just decided not to continue working in the same way or not even asking for a license. I have to say it is a very costly process. And the last thing that MiCA regulated, as you know, was also the definition of basically crypto assets and the issuance. There we have around 800 white papers issued. You probably heard mostly coming from Ireland, so connected with the Bank of Ireland. But there has been some activities, of course, as you mentioned. I think the really important question are the stablecoins. We know that stablecoins were regulated very severely since the beginning and were basically the reason for MiCA. But at the same time, I have to say that the Genius Act kind of took a little bit from MiCA. Like the standards on stablecoins really happen in Europe. I'm not sure how, in a way, DeFi will be regulated or what will happen with the Clarity Act now on the other side. But at least this we have to kind of admit. And I would say that it's not maybe going into even a better direction, but it's getting even more scrutinized when it comes to stablecoins. We had a whole year of discussions around multi-issuance when it comes to stablecoins in the EU, which means that there's question, mostly the European Central Bank is questioning the fact that issuing a stablecoin that is fungible all over the globe could be limiting to the European Union financial stability. So the idea is really to issue a stablecoin that would be fungible only within the EU, within the European Union market. And in this way, there would be more control over who could redeem these stablecoin to fiat, taking into consideration the reserves that all the issuers have to have in European Union banks. So basically, this is the framework that we're dealing with. As I said, more than a year. It's, I think, unprecedented, the level of discussions and how many institutions were involved in that. And we are expecting some solutions pretty soon, but it might even result in the reopening of MiCA or the other package that we're currently negotiating, the markets integration package.
Could I add something on this topic? I just want to say that I think it's pretty disappointing that we haven't made more progress on Euro stablecoins. Common digital money, to me, would be very positive for the integration mission, broadly speaking. The fragmented banking system, capital market system is something that slows European integration. I think stablecoins could be a positive catalyst. And I think something that could two things that could speed this up, maybe turnover at the ECB. I personally think that Isabel Schnabel probably is more open to stablecoins than Christine Lagarde, so maybe some turnover of the leadership of the ECB will help move things along. And I would also not understate the importance of the level of interest rates. When you have interest rates low, it damages the economics for a stablecoin issuer. The higher the interest rates get, the more economically motivated issuers are to come to market. So maybe some turnover at the ECB, somewhat higher interest rates. I think these can be catalysts for more adoption of euro-denominated stablecoins.
I mean, I think it's hard to talk about euro-denominated stablecoins without talking about the digital euro project, which is a big part of how the European Union is approaching sort of digital currency, which does not, I mean, I don't think they've actually decided that it's going to be issued on a blockchain yet. I think they're still in a technology consultation on that. But that is part of how the ECB is pushing forward their view of cash replacements, and what a self-custodied asset that gives you a direct relationship with your central bank could look like in practice for retail, with pretty significant limitations around it, specifically because of concerns with stability of bank balance sheets. I think if you look at that project that's now years in the making, that's actually an EU project and needs to be backed, you can see some of how they're thinking about implementation of these types of products, which I think is quite telling.
Right. I think there's two other, well, there's one other, I think, key issue, which is the UK, which is really still, in many ways, the financial capital of Europe, does not have MiCA. Right? MiCA is good legislation, and the UK remains outside of that, which is a problem because British banks and financial institutions are not deeply engaged in this, and frankly, the UK does not have comparable legislation, which is a big gap. Despite that, it's very encouraging. I did go and look up the other day a stablecoin, non-US dollar stablecoin performance, and it is now finally rising at a transaction rate that's actually higher than US dollar stablecoins. And I consider that to be one of the key measures of institutional adoption is non-US dollar stablecoin adoption, because almost all the non-US dollar demand is coming from institutional users and enterprises in mature markets. In emerging markets, people just want dollars. It's super simple. That drives that volume. If you're seeing volume, like it really is spiking in the last 6 months for the non-US dollar, and I think that's going to be a good indirect measure of how quickly this is actually getting practically adopted in the EU especially.
If I may, just the last thing, a very important project currently being discussed in the European Central Bank is Appia in Pontes, basically the tokenization of central bank money, another added to the digital euro, but the consultation is happening just this month. And I would say, and I'm not exaggerating, I think this year there's going to be very important decisions being taken in the EU and in the UK, as you mentioned. It's going to be, I think, as important as at the beginning when we discussed MiCA. It's all about tokenization, is the review of MiCA, is the new MiCA for the UK, stablecoin regulation for the UK. So if anyone here is interested to, I would really, I would say recommend to engage right now.
I love how our panel shifted into discussion of money. If you were here for the ECC last year, you will see the difference in the topics that are being discussed. We used to argue a lot about mass adoption. How can we bring more Web2 people to crypto? But now the focus of money is changing as well. So I'm turning to Ophelia with my question. In the past, we were trying to capture as much retail as possible, but right now, big institutions like Bank of America, Vanguard. They are competing for opening crypto access to their clients, to high net worth individuals. What are some risks and potential benefits for picking solutions that weren't designed by the crypto natives?
So we're entering a really interesting moment, which is you are starting to see traditional financial institutions compete with crypto native firms to offer crypto services in a bunch of different ways. Most of those today are largely targeted at either buy and hold investors or people who are trading crypto assets for investment purposes. I think what you are going to see is I think you're going to see some consolidation. I don't believe all of the traditional firms will be able to roll out effective products. They will rely significantly on infrastructure provided by crypto native firms. And I'm quite bullish on firms who are doing that and providing back-end infrastructure. The traditional financial firms have the distribution. They do. They have the distribution, they have the relationships, they have the clients. For the most part, while retail is important in terms of number, it is not important in terms of ticket size. Most money in most jurisdictions is intermediated in some way, ranging from 401ks in the US to pension plan schemes in Switzerland to, every nation has structures like this where that is where you're going to see the majority of capital. So I think you will see these traditional firms ease how their largest institutional clients are going to be able to get into this space. Now, when it comes to picking which products to actually use, I think crypto native firms bring an edge in terms of actual know-how and delivering a robust client experience, but they are not as far ahead in terms of the depth of that client experience and the number of touch points. So I think you're going to see increasing numbers of partnerships, increasing cooperation around how to actually deliver this value to customers, and some element of diversification from most major clients across crypto native firms and traditional firms as they try to figure out where they're going to get the right level of client service. And I think that's something that's quite exciting. It's going to push adoption into a very different chapter where we're now going to be dealing with real institutional money. And people have been saying for years, the institutions are here. Hedge funds are not real institutions. They are wonderful and they have a lot of capital and they love to trade. But when you talk to people in TradFi about institutional money, they mean sovereign wealth funds, they mean pension plans, they mean a significantly higher level of sophistication. And I think one of the wonderful things in seeing all these TradFi firms come in is you're going to start to unlock that conversation in a really structured way, and you can certainly see some of that benefit in the last couple of years, and I expect it to continue.
I sort of think there's a fork in the road here too, which is, are we just going to be plumbing, or are we going to be like a source of incremental value add? And what I mean by this is fundamentally like, okay, I'm a Schwab customer, I go into my little Schwab portal, I want to buy some IBM stock. I don't care what plumbing you use to fulfill it. I don't really care whether you buy this stock on the New York Stock Exchange from a dark pool or a bunch of tokens from Canton. It doesn't matter to me. But what I would be interested in is if you told me, hey, Paul, I can squeeze an extra half point of return on that investment because we can stick it into a DeFi liquidity protocol. And so for me, the big issue about what will drive some long-term value proposition is, are we just going to be plumbing? Is the plan that we're just going to be cheaper than centralized infrastructure? Because as far as I can tell, and I will admit, I spent 15 years at IBM, you cannot beat an IBM mainframe on transaction processing cost. But if we are going to be value add, if there's going to be 500 DeFi protocols I can choose from to squeeze a little bit of extra return from my assets, that I am interested in. And even though lower interest rates reduce the value proposition of stablecoins, they vastly multiply the value proposition of DeFi because the search for yield starts to get really intense.
There were so many topics brought up today. For people who have been in crypto for a long time, they are used to define crypto cycles with certain narratives, with certain terminology. We've had DeFi summer, we've had the start of tokenization, the first stable coins, meme coins, God forbid. Zach, what in your opinion defines this cycle, and what is the biggest narrative that you predict for the second half of 2026?
Well, let's hope it's not quantum apocalypse. I think that's what we're all fingers crossed. Maybe I'll pick up from Paul's comments. I think, look, I think the narrative is the dawn of the institutional era for crypto. Use of the technology, investing in the asset class, all of those things are happening. But I kind of agree with Paul that some of it is crypto just becoming plumbing. I guess the thing that I would add is I think maybe there will also be a bifurcation among what you could call the exports of crypto, stablecoins, tokenized assets, blockchain for efficiency in the financial system, and then the remaining cypherpunk core piece, which is what will always be properly distinct from traditional finance. I don't think crypto is just about those exports. It's about giving people an alternative to the traditional financial system that allows self-custody, permissionless innovation, censorship resistance, those properties. And so maybe I think we're seeing maybe a clear distinction between these types of things. Maybe something like Canton on the one side, which I think is a perfectly valid investment and product, and other things like Bitcoin and Ethereum and Zcash that are sticking closer to those core principles. So institutional eras seeing adoption, but also maybe drawing a finer line between the things that can be adopted by traditional finance and the parts of crypto that really offer a distinct alternative from traditional finance.
Well, I think one thing is, taking Bitcoin as a great example, you're going to continue to see institutions invest more in Bitcoin. You're going to start to see government money in Bitcoin. I think that's pretty consensus as a view over the next 5 to 10 years, possibly sooner if we get lucky. I think what's interesting is I think the balance of institutions to more peer-to-peer cypherpunk side is shifting. And I think whereas in previous iterations of these markets, crypto is a very insulated market, right? We all traded with each other. You all dealt with each other. It was a very small relative to the rest of the world pool of capital. And the links between this sort of isolated market and the broader financial system are continuing to increase. That's going to result in macro sentiment having a bigger impact, and in having how retail feels about X, Y, or Z have a bigger impact. But I also think it's going to shift a lot of the dynamics in the space. And while I agree there will definitely be some interesting, truly value additive products, I think the standards that are going to need to apply to those products in order for them to be mass market appealing to people who are largely going to be using these in an intermediated way that they may not even be aware of is going to require us to level up the product experience, the compliance that we put in, how we think about regulations. I don't think regulatory light is where the future is. I actually think it's the opposite. I love regulations. I think we're going to get more of them. I think that's a net fabulous thing for our industry. And I fundamentally think that's going to shift what the balance of power and center of gravity is going to be in the sector.
I would go back to the plumbing. For the last 6 years, we have been discussing about assets. What is the definition of an asset? We have cleared that question in Europe. I'm not sure what's happening in the US still. But we discuss a lot about the asset and crypto as a service providers. Right now, we really do talk about tokenization. They're very concrete questions that are coming from regulators, usually banks from the banking sector, but also banking associations. So what is the governance of the specific layer one in this case? What we're dealing with is, of course, Ethereum. What is the finality of transactions? How do you build interoperability? What is the liquidity on the layer ones? How do we decide what blockchain to use? And I think in this case, it is really an important moment to have these discussions with regulators and banks and TradFi right now, and just showcasing that this infrastructure is robust, that they can trust it, that it has existed over so many years already, no downtimes, etc. And it is something that is by default interoperable, just because of the MEV and the interoperability that has been built until now. But it is true that we do have to work on standardization. It is really important, even right now, when we go and speak to the banks and regulators, I would say it is really hard to find the right professional that has all this multidisciplinary knowledge about what's happening right now on a technical side, regulatory side, then business side. And basically propose the solutions updates to the regulators, the one they need right now. I think many times we do think that they're not educated, they don't know enough about what's happening, but they do write, for example, they describe a consultation and they get 500 or even more papers back to the questions that they ask. Like in just a week, they learn more than we learned in the last years.
We're hitting the end of our discussion today. I wish we had a little bit more time. I'll summarize everything we've talked about today. Crypto has gone from being associated with pretty gray ICOs when it was enough to have 3 Ws, a website, white paper, and a wallet to raise money, to finally having proper regulatory frameworks, to attracting so many legacy institutions on chain, to building solutions that appeal both to Web 2 and Web 3 companies. But the problems that were existing for retail stayed the same for institutions. We need products that actually make sense, that have good UX, that have good solution for the pain points. And we're hoping that when we gather in 2030 in the same room with our friends, we will see much greater adoption and the products actually solving real problems. We had an amazing line of panelists. We thank you for your time, and please thank them.